What makes Warren Buffett, one of the wealthiest people on the planet, so successful in his investments? This is a question that has intrigued many for decades, and today we're going to dive into the story of this billionaire investor to uncover the blueprint that has led to his remarkable success. Warren Buffett, the Oracle of Omaha, was not born with a silver spoon in his mouth. He hailed from a middle-class family in Nebraska. His father was a stockbroker, and young Warren's exposure to the world of stocks and shares began at a tender age. He bought his first stock when he was just 11 years old, and by the time he was 15, he had already made several profitable investments. Buffett's investment journey truly took off when he met his mentor, Benjamin Graham. Graham was a proponent of value investing, a strategy that involves buying securities that appear underpriced. It was under Graham's tutelage that Buffett honed his investment skills, learning to look beyond the numbers and understand the intrinsic value of a company. In the mid-20th century, Buffett crossed paths with Charlie Munger, a fellow investor and lawyer. This partnership was a turning point in Buffett's career. Together, they transformed Buffett's company, Berkshire Hathaway, from a struggling textile firm into a successful holding company. Their strategy? Investing in businesses they understood and believed in for the long haul. Buffett's early investments, like American Express and Coca-Cola, were not just bets on companies, but on the future of American business. He didn't just follow the crowd, he set his own path, guided by his deep understanding of the businesses he invested in and an unwavering belief in their potential. This was just the beginning of Warren Buffett's path to becoming a billionaire investor. Over the years, his blueprint of value investing, long-term commitment, and partnership with Munger has not only made him one of the wealthiest people on the planet, but also a beacon of wisdom in the world of finance. The cornerstone of Buffett's success lies in his value investment strategy. But what exactly is value investing? Value investing is an approach that involves seeking out stocks and buying them for less than their intrinsic value. The intrinsic value of a stock is the estimated true worth of the company rather than the current market price. This strategy is like hunting for hidden treasures in the stock market. The concept of value investing was introduced by Benjamin Graham and David Dodd, professors at Columbia Business School in the early 20th century. They proposed that investing in companies with solid fundamentals but whose stocks were undervalued by the market could yield significant returns over the long term. Warren Buffett, a student of Graham, took this concept to heart and became its most famous proponent. He applied this strategy with a twist, focusing not just on the numbers but also on the quality of a company's management and its ability to generate consistent profits. So why does Buffett advocate so strongly for this strategy? It's because value investing is based on the principle of buying low and selling high. It's about finding gems that the market has overlooked or undervalued, and then patiently waiting for the market to realize the true value of these gems. Buffett's approach to value investing is also about discipline and patience. It's not about making quick bucks, but about investing in companies that have a solid business model, good management, and are priced well below their intrinsic value. This strategy requires a lot of research, analysis, and above all, the patience to wait for the right opportunity to buy and the right time to sell. It's not a strategy for the faint-hearted or those looking for quick returns. It's a strategy for those who believe in the power of patience, discipline, and long-term thinking. Buffett's application of the value investing strategy has proven to be quite the game changer. This approach to investing has not only made him one of the wealthiest individuals in the world, but it has also stood the test of time, proving its value over and over again. Buffett is known for his long-term investment approach. Why is this so crucial to his success? This question often piques the curiosity of many. Let's delve into the reasoning behind this successful strategy. Warren Buffett, the Oracle of Omaha, is not a day trader. He's not interested in the daily fluctuations of the stock market. Instead, he focuses on the long game. He believes in the enduring value of companies and their potential for growth over time. But why? What makes this approach so successful? Firstly, it's all about patience. Buffett's long-term investment strategy allows him to weather the storm of market volatility. While others panic and sell when the market takes a dip, Buffett remains calm and composed, knowing that the market will eventually recover. His philosophy? Our favorite holding period is forever. Secondly, this approach is based on the fundamental belief in the growth of the economy. Despite short-term ups and downs, the economy tends to grow over the long run. By investing in strong, stable companies, Buffett banks on their ability to capitalize on this growth. Lastly, long-term investing reduces the cost associated with frequent trading. Every time you buy or sell a stock, you incur costs. These costs, although might seem small, can add up over time and eat into your returns. By holding on to stocks for longer periods, Buffett minimizes these costs, thereby maximizing his returns. But remember, this strategy is not for the faint-hearted. It requires a deep understanding of the businesses you invest in, unwavering patience, and an iron stomach to withstand market fluctuations. It's not about timing the market, but time in the market. Buffett's long-term investment strategy is not a secret formula. It's a testament to his discipline, patience, and belief in the power of compound growth. His approach may not guarantee instant gratification, but it does promise potential for substantial growth over time. Buffett's long-term investment strategy has undeniably played a significant role in his success. It's a strategy that stood the test of time and one that could potentially guide you on your journey to financial success. One of Buffett's key strategies is leveraging the power of compound interest. But how does it contribute to his success? Let's dive into the magic that is compound interest and its role in Warren Buffett's investment strategy. The beauty of compound interest is in its simplicity. It's interest earned on initial capital and on the accumulated interest from previous periods. Imagine planting a single apple seed. Over time, this seed grows into a tree that bears apples. Now, if you take those apples and plant their seeds, you'll have even more apple trees. This is the essence of compound interest. Your money grows, then the growth grows. Buffett, the Oracle of Omaha, understood this principle early in his career. He realized that the longer his investments could earn compound interest, the more his wealth would expand. This is why he's known for his buy and hold strategy. His long-term investments have had decades to benefit from the multiplying effect of compound interest. Let's put this into perspective. If Buffett invests $1 million at an annual interest rate of 5% after a year, he'll have earned $50,000 in interest. If he leaves that interest in the account, the next year he'll earn interest on $1,050,000. Not just the initial $1 million. Over 30 years, that $1 million would grow to over $4 million, even if he never added another cent. This strategy has been a major contributor to Buffett's wealth accumulation over time. It's not about making quick returns or timing the market. It's about patience, allowing time to do the heavy lifting. Buffett himself has said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." So, if you're looking for a secret to Buffett's success, it may just be this: understanding the power of compound interest and having the patience to let it work its magic. The power of compound interest has indeed been a major player in Buffett's investment success. It's a simple principle, but when applied consistently over time, it can yield extraordinary results. Now that we've delved into Buffett's key investment strategies, let's summarize the principles that guide his investment decisions. At the heart of Warren Buffett's investment philosophy lies the concept of value investing. Rather than chasing trends and hot stocks, Buffett emphasizes the importance of identifying undervalued companies with solid fundamentals. This requires patience, research, and the ability to resist the siren call of short-term gains in favor of long-term growth. Next, we have the principle of long-term investing. Buffett is a firm believer in the power of time in the market. He's not interested in making a quick buck. Instead, he's focused on the long haul, holding onto his investments for years, even decades. This approach allows him to weather the ups and downs of the market, taking advantage of the growth that occurs over time. And let's not forget the magic of compound interest. This principle, often overlooked by many, is a key driver of Buffett's success. By reinvesting his earnings, Buffett allows his wealth to grow exponentially over time. The power of compound interest is such that even small investments can grow into substantial sums given enough time and patience. But these principles are not standalone. They work together, creating a synergistic effect that has allowed Buffett to achieve his remarkable success. Value investing identifies the opportunities. Long-term investing allows them to mature, and compound interest fuels the growth. So what does this all mean? It means that investing in the style of Warren Buffett is not about making quick decisions or following the crowd. It's about patience, research, and understanding the value of time. It's about seeing the potential in companies that others overlook and having the courage to invest for the long term. It's clear that Warren Buffett's success is not due to luck, but a result of his unique investment strategies and principles. And while not everyone will become the next Warren Buffett by adhering to these principles, one can certainly improve their chances of investment success.